Welcome to the Canadian Investors Course, Session 9, Investment Industry Products and Fees. As with all the other segments, please read page 2, Terms of Use and Disclaimer. Today we're going to talk about investment products and fees. Who offers the products, the type of investment accounts you can obtain, and investment account fees. What's out there? First of all, how's everybody paid? Do they get commissions? Are they fee-based? Is it salary and commission, or is it salary? Who gets what? Independent planners are typically paid on commission. They get a commission on what they sell. You may see it, you may not. In other words, it may be hidden or it may not be hidden. If it's hidden, chances are it's in the form of a trailer fee. Trailer fees are fees that are paid by mutual fund companies to the advisor for loyalty. In other words, to encourage them to keep the funds or to keep funds in general. Bank salespeople and planners tend to get a salary or a salary plus bonus. Sometimes they get salaries, bonus, and commissions. The pay structure is constantly changing, but they are incented to sell you things. And the fees are almost always hidden. Insurance agents. Insurance agents receive commissions on their insurance sales. They receive trailer fees on their mutual funds and seg funds that they sell, and some of them receive a salary and a bonus. IROC securities dealers receive commissions if they're transactional based, and perhaps if they sell mutual funds, they're going to get trailer fees, and if they use a managed account strategy, they're going to get a percentage fee on the accounts managed, on the assets managed. Now, let's look at the investment products. Individual securities such as stocks, bonds, money market, ETFs, preferred shares, precious metals, etc. are either purchased with a commission charged up front for the purchase and a commission charged upon the sale, or are built into the cost is built in if it's a fee-based account. In a fee-based account, the account gets charged a flat fee on a periodic basis, and it covers all transactions. That's why the commission accounts are called transactional accounts versus fee-based. Mutual funds charge a management account expense ratio known as MER, and the MER is somewhat invisible. It's not completely hidden. You can find it if you look at the fact sheet, but it's not out there unless you ask for it. It's not shown as a separate item. That's changing with current legislation, but that's been traditionally the way. This can vary from 1.25% to 2.5% a year. The mutual fund salesperson who recommends the product is paid in one of two ways. Either they receive a deferred sales charge. If they receive a deferred sales charge, the salesperson is paid 5% of the total amount invested up front. This is not visible to the client unless it's disclosed. And the investor will get charged a fee if they sell within the deferred sales charge period, which is typically 6 or 7 years. And usually on the statement, it'll indicate that it's a deferred sales charge fund because it'll say DSC somewhere near the fund. The other option that the advisor has is to charge a front-end load. There, the salesperson can charge anywhere from 0 to 5% up front, and you see the fee. And in this case, the advisor can sell the fund anytime they want with no additional charge. Also, there are low load funds, which are basically also called short DSC funds, where the salesperson receives a smaller upfront fee, and there is a charge to sell it if sold within the 2 or 3 year low load period. All forms of purchases pay the salesperson a trailer fee, and the trailer fee is paid every year, and it can range from 0.5% to 1% typically. Mutual funds at the bank or credit union also charge an MER. The salespeople are not paid a commission, but most likely they're paid a bonus based on the amount sold to the customers. And the bank receives a trailer fee in most cases on the funds that are sold. So if the advisor sold that bank fund, the advisor, an outside advisor, would receive the trailer fee. And if there is no outside advisor, the bank receives the trailer fee as additional profit to the bank. Wrap accounts are becoming very popular. Generally, sellers of this product do not charge a commission to purchase the program. They receive a portion of the total MER, or general management fee, usually up to half the fee, as their way of being paid. Most of the fee is disclosed every year, except the fees charged by the internal managers chosen to invest the money. These fees are generally hidden, but they're packaged into the total fee. You can ask your salesperson if there are any hidden fees. The fees are similar to the MERs on mutual funds, except for a large portfolio where it can be negotiated down for the client. Find out if you qualify and shop around. The benefit of a wrap account is that it does separate part of the fee out, making it tax deductible, in a non-registered account. Unified account fees are structured similar to wrap accounts, and the same comment applies. The management fee component that's grouped in is usually not tax deductible, but the unified account fee is tax deductible in non-RSP registered accounts. Another form of mutual fund is a pooled fund. These are used by some of the high net worth systems for the banks, like private banks and so forth. They're part of the wrap account programs, and the fees are not readily disclosed, but you can ask about them and you can find out if what the fees are. If you ever hear anybody tell you that it's free, that's time to take your money someplace else, because you don't invest your money for free ever anywhere. Exchange traded funds, ETFs, they're like mutual funds. The fees are hidden, but they're smaller. And when we say the fees are hidden, it means that they may not be verbally disclosed. You can always find the fees. All you have to do is look the fund up on the internet, and you can find the fee. It's going to be published in a fact sheet or something like that. It's not difficult to find, but you may have to look for it. CRM is forcing this to come to the surface. It's forcing the industry to show the fees. So if you ask your advisor, they must tell you what the fees are. Certainly they're lower than mutual funds in most cases, but be cautious, because there are now some exchange traded funds that have pretty substantial MERs. They are a good packaged product in general, though. They provide, they're a little bit more transparent than most mutual funds. Segregated mutual funds are mutual funds sold by insurance agents and IROC licensed advisors. They typically have an insurance wrapper on them of some sort, and therefore they're a little more expensive. The MERs are hidden, and CRM legislation in 2017 will not force these fees to be disclosed. But nevertheless, if you ask about them, the company is obliged to tell you what they are. They tend to be a little higher, ranging from 2 to 4% a year, and the salesperson gets paid in a similar fashion as for other mutual funds. In other words, they may or may not receive a fee up front. They may be subject to DSC, and the salesperson probably receives a trailer fee. Investment accounts and fees. Now, regular commission investment accounts, these are called, by the brokerage firms call them transactional accounts. These allow investors to invest in almost any instrument in Canada, from GICs to stocks and bonds. There are full-service investment accounts offered by investment advisors providing advice and there are also discount brokers. So there's two ways. You can go to a discount broker, no advice. Full-service investment accounts come with advice. If you know what you want to invest and feel you don't need the help of advice and can do your own research, go to the discount broker and save huge fees. They're up to 90% lower than full-service advisors, but you will get absolutely no advice. Transactions can be from a few pennies to $10 a trade. Fee-based accounts. These are very popular and are offered by full-service IROC licensed advisors. The advisor's firm charges a flat percentage on the total value of the portfolio every year. All transactions in the account can be executed with no additional charge. So basically, it's the no-frills account. In this way, this is the way to go if you need advice. You get unbiased advice because really, you and the advisor are on the same side of the table now, because the advisor has every interest in growing the account because that's how they can grow their fee. Be aware that advisors can use mutual funds in these accounts, and typically they would use an F-class mutual fund, and then they would tack their fee on top of it. That means that the fee that they charge is tax deductible. However, the management fee component of the F-class fund would not be. The advisor does not get the trailer fee to hold the fund, so you pay the lower MER and an upfront fee to the advisor that you can see. One could argue that this account's a bit controversial because it reveals the limitations of an advisor, and it reduces the work for the advisor, and the overall fees may be a little higher. If you're going this route, the banks offer similar accounts at lower fees. Fees on fee-based accounts vary between different investment firms and between advisors in the same firm. So you should ask the question and perhaps shop and compare. And by the way, a lower fee does not necessarily mean lower advice or quality of advisor. It may simply mean that they feel that that's an adequate fee for them to charge. Reach out to a trusted wealth professional using a locator on this website and obtain the fee schedule and ask them questions about what you should pay. Once you've chosen an advisor and accepted the fee schedule, start working together so that it becomes a partnership. Look at the next few CIC sessions on packaged products and learn more about using money managers through mutual funds, wrap accounts, etc. CRM legislation in 2017. Investor protection. CRM refers to the second round of changes under client relationship model, an initiative of the Canadian Security Administrators. These are new rules for what financial institutions need to disclose to clients, including 2 new annual reports that will include the cost of advice and the annual portfolio performance. CRM applies to everything from mutual funds to stocks and bonds starting in 2017. Expect to receive the reports in January 2017, providing investors with a 2016 summary. Fees that the advisors pay are reported in dollars and cents, not percentages. In many cases, only half or a portion of the fee will be reported because they only report the fees received by the brokerage house. So in other words, if we bought a mutual fund, for example, and there was a trailer fee, the trailer fee would be reported, but the management fee that the mutual fund company received would not be reported because that's not received by the brokerage house. In 2018, it's expected that all or full fees will be disclosed. Mutual fund and wrap account investors will most likely be affected because generally they have hidden fees. Some investors never knew that fees were charged annually at all or how much. So lots of people are going to be shocked. Fee-based IROC investment managers for portfolios, i.e. trusted wealth professionals who use individual securities, have always disclosed fees because the fees are tax deductible when charged outside retirement accounts. No change there with the new legislation. Fee-based accounts with mutual funds and ETFs in them will not disclose all fees, so you have to be asked to show all the fees in dollars and cents. Your advisor has the information and will be pleased to show it to you. Insurance products such as seg funds will not be forced to reveal fees charged to investors, at least at this time. There doesn't seem to be a reason why the government doesn't include insurance products. However, you can ask your insurance agents how much you will be charged annually in dollars and cents, how much the agent was paid in commissions, and what the trailer fees were. They have to tell you the answers if you ask them. Insist on dollar and cents in the answer. Your agent definitely has this information. And there is talk that this exclusion may be altered in 2018. That's the end of segment 8, fees and so forth in the investment business. Thank you for listening.